Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are trying to hide or highlight in their filings. Strap yourselves in, because Plum Acquisition Corp. the third has filed its quarterly report, and folks, it sounds like a SPAC trying to stretch its wings amid some serious turbulence. Alright, let's dive into the numbers. As of the 30th of September 2025, Plum Acquisition Corp. the third had cash of about $107,000. Now that might sound small, but remember this is a SPAC, meaning its main job is to find another company to merge with. What is really striking is how their investments held in trust account has plummeted from over $25 million at the end of 2024 down to just about $490,000 by September 2025. This is a huge indicator that a lot of shareholders have been cashing out, meaning they probably don't see a business combination happening anytime soon, or they just want their money back. On the flip side, their total liabilities shot up from about $5.3 million to over $7 million in the same period. This increase is largely driven by a significant jump in accrued expenses and other current liabilities, which went from roughly $1.4 million to over $2.4 million. It also includes a growing promissory note to related parties, which went up by about $800,000 to over $2 million. This suggests the company is leaning heavily on loans to keep the lights on as it struggles to find a deal. Now let's look at how the company is performing on its income statement. For the third quarter of 2025, Plum Acquisition Corp. the third reported a net loss of about $276,000. That might not seem like a lot, but remember they are a blank check company, so they aren't really operating a business yet. Their main expenses are operational and formation costs, which were a whopping $521,000 for just 3 months. Meanwhile, their income from interest and dividends on their trust account holdings was a mere $6,868. Looking at the 9-month period ending the 30th of September 2025, the net loss is even more substantial at over $1.5 million. Again, the bulk of this loss from operating and formation costs, which tallied up to more than $1.7 million. This is why we see their cash reserves outside the trust account dwindling. This next statement really highlights the precarious financial situation. As of the 30th of September 2025, the total shareholders deficit stands at a negative $6.8 million. This means the company owes more than it owns by a considerable margin. It is a sea of red ink with accumulated deficits growing year over year. What is particularly concerning is the remeasurement of Class A ordinary shares to their redemption amount. This adjustment is eating into their equity, pushing that deficit further negative. Looking at the cash flow statement for the 9 months ended the 30th of September 2025, we see that net cash used in operating activities was over $740,000. This is a direct result of that ongoing net loss and operational expenses. They also pulled over $25 million from their trust account to pay redeeming shareholders. This is a massive outflow and shows that many investors are choosing to get their money back rather than wait for a business combination. In terms of financing activities for the same 9-month period, they used over $24 million. This is mostly again due to those shareholder redemptions, which as we saw are really draining their cash. They did bring in about $820,000 from a promissory note with the sponsor, which is a lifeline, but it also increases their liabilities. So what is Plum Acquisition Corp. the third really doing? Well, they are a blank check company formed to merge with another business. They were supposed to complete a business combination within a certain time frame, but they have had to extend it multiple times. This constant need for extension signals difficulty in finding a suitable merger target or getting shareholder approval. The fact that they are still around is largely thanks to extensions funded by their sponsor. This section in Note 1 is crucial. Plum Acquisition Corp. the third states they have a working capital deficit of nearly $4.8 million as of the 30th of September 2025. This means they may not have enough money to operate for the next 12 months. The report explicitly states there is substantial doubt about the company's ability to continue as a going concern. This is a really strong warning sign for investors. They are essentially saying they might not be able to stay in business. Now let's quickly touch on how they do their accounting. They are an emerging growth company, which means they get some breaks on reporting rules. But importantly, they've elected not to opt out of the extended transition period for accounting standards. This means they can adopt new accounting rules later than other companies, which can make it a bit tricky to compare their financials directly with others. Remember, back in July 2021 when they did their IPO, they raised $250 million by selling units. Each unit had a share and a fraction of a warrant. They also raised another $32.5 million from an over-allotment option shortly after. This initial capital is what gets put into that trust account, with only a small portion outside for operating expenses. This is where things get interesting. The sponsor Mercury Capital LLC and the original sponsor Alpha Partners Technology Merger Sponsor LLC are heavily involved. We see these sponsor promissory notes and subscription agreements. Essentially, the sponsor is loaning money to the company to keep it afloat and to fund extensions. A significant portion of their liabilities comes from these related party loans. The fact that the company is so reliant on the sponsor for funding highlights its weak standalone financial position. Warrants are a common feature of SPACs. They give holders the right to buy a company's stock at a set price. Plum Acquisition Corp. III has founder warrants, private placement warrants, and public warrants, all with an exercise price of $11.50. A big point here is how these warrants are classified as liabilities, not equity. This means their value is re-evaluated each quarter and changes in their fair value are recorded as gains or losses impacting the income statement. This can create volatility in reported earnings. When it comes to segments, Plum Acquisition Corp. III has only one because it's a SPAC focused on finding one business combination. Their chief operating decision maker, the CEO, looks at the company as a whole. They track things like the trust account balance and operating costs to manage resources efficiently. Here, the management talks about their efforts to find a business combination. They admit to incurring significant costs and that they may have insufficient funds beyond the next 12 months. They also mention the possibility of needing additional financing. The consistent theme is the company's struggle to find a deal and its reliance on external funding from the sponsor. We can see several instances where shareholders voted on extending the deadline to complete a business combination. Each time this happened, many shareholders chose to redeem their shares. For example, in July 2023, over 13 million shares were redeemed. Then in January 2024, another 12 million shares were redeemed. And again, in January 2025, over 2 million shares were redeemed. This massive redemption activity shows a significant loss of confidence from public shareholders. This section details a really important change. On the 27th of December 2023, the sponsor Mercury Capital LLC bought founder units from the original sponsor Alpha Partners Technology Merger Sponsor LLC. After this, the sponsor basically took over all the obligations and responsibilities related to Plum Acquisition Corp. III. This means the sponsor is really the one driving the bus now and is on the hook. They have entered into a business combination agreement with Tactical Resources Corp. This is the potential deal they are working on. However, there have been multiple amendments to this agreement suggesting negotiations are complex and perhaps facing challenges. The latest amendment extended the deadline to the 30th of July 2026. This is a clear sign that the deal is not simple or close to completion. This is a big one. On the 27th of January 2025, Plum Acquisition Corp. III was delisted from the Nasdaq stock market. Their securities are now trading on the pink current tier of the OTC markets. This is generally considered a less prestigious and less liquid market. Trading on the OTC means they failed to meet Nasdaq's listing requirements. This is not good news for their liquidity or investor perception. Management reiterates that they haven't generated operating revenue. Their financial results are driven by interest income and changes in the fair value of their warrant liabilities. For the third quarter of 2025, they reported a net loss of $276,000. This loss is largely due to operating and formation costs, which outpaced the minimal interest income they earned. This aligns with the overall picture of a company burning cash while trying to secure its future. This part is extremely important. As we mentioned earlier, the company has a significant working capital deficit, and frankly, the report screams going concern doubts. They are running out of money and are relying on sponsor loans. The July 2026 deadline for a business combination is their last shot. If they don't find a partner by then, it is liquidation time. This is the most critical takeaway from this report. As a smaller reporting company, they don't have to give us all the nitty-gritty details about market risk. This suggests their financial operations are simple enough that these risks are not a major focus or are considered immaterial. Okay, so here's a bit of a red flag when it comes to internal controls. The company acknowledges a material weakness in internal controls related to compliance with agreements and the proper recording of accruals and stock-based compensation. This means their financial reporting might not be as robust or accurate as it should be. They are working to improve this, but it does raise questions about the reliability of their past financial reporting. So what is the verdict on Plum Acquisition Corp. III? Well, the numbers paint a pretty grim picture. They are burning through cash at an alarming rate with little to no operating revenue. Their heavy reliance on sponsor loans and the repeated extensions for a business combination signal a company struggling to execute its core strategy. The delisting from Nasdaq and the acknowledged material weakness in controls do not inspire confidence, while the business combination with Tactical Resources Corp. is their main hope. The numerous amendments and the distant deadline suggest it is far from a done deal. The massive redemptions by shareholders clearly indicate a lack of faith in a successful outcome. It really looks like a classic SPAC facing the music and struggling to find a partner before its time runs out. Alright, that is our breakdown of Plum Acquisition Corp, the third's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description to keep the conversation going. Thanks for watching, and well, see you next time.